Trying to time the market is very stressful, and honestly, it is impossible to do. Think about it this way. Rationally, when the market dips, how do you know if that is the right time to buy? If that's the right time to buy, how much do you buy? What if the market dips further? Then, if you bought then because you thought that was the right time, then you were wrong. But if you did not buy and the market went up, then you are wrong as well. No matter what you do, if you buy when the market first dips, there's a possibility of you being wrong if the market dips again. If you don't buy then and the market goes up, there's regret that you should have bought then. And even if you bought, there'll always be the question of, should I have bought more? Should I have bought less? Should I have spent half of my money now and then it dipped further and another half then? The point is, trying to be accurate in investing is impossible, especially as a beginner investor or an untrained investor. The folks who are able to accurately time the market like hedge funds do it with very, very advanced financial models. So not even humans. They have algorithms that detect slight changes in the market and are able to respond very quickly. But you as an individual investor, just looking at your stock on your phone or your laptop, you are just not equipped to be able to make that kind of judgment. But what does that mean for you? Does that mean that you are stuck actually making bad investment decisions? No. In this video, I'm going to review to you an investing strategy that averages out your costs and returns in the market over time, and especially takes away the stress and the anxiety with making investment decisions like, when should I buy? Should I buy the dip? How soon should I buy? And how much should I invest? If you are new here, hi, I am a CFA charter holder. I'm a former investment banker, and I spent about 7 years advising millionaires and billionaires on how to make, keep, and grow their money. And on this channel, I share strategies that will help you build wealth, just like this investment strategy that you are about to learn. I'm going to talk about the strategy, examples of the benefits, I'll tell you how to implement it, and I'm going to share these tips in simple, beginner-friendly ways so that you can take action from this video today. The strategy in question here is dollar cost averaging, also known as DCA. Now, DCA is an investment strategy where you invest some amount of money at regular intervals into whatever asset that you are buying, irrespective of the price. Now, this will work if you're investing in stocks or in index funds or an ETF. You can apply it, to any of this. By applying DCA, you spread your investment into the market over time without having to worry about the dips and the spikes and the various movements of the market. And over time, what happens is that your average cost is smoothed out. That's why it is called dollar cost averaging. To bring this home to you, I'm going to give you two examples. The first one is, let's assume that you typically invest $500 every month. And in the first month, the asset price is $50. Automatically, you buy 10 shares. Let's now say in month 2, the asset price has gone down to $25. What happens is you buy 20 shares. And then in month 3, the asset price has gone back up to $100. You buy 5 shares. You can see that the amount of shares that you buy on a month-to-month basis, varies. But the amount of money that you invest every month remains the same. Now, let's get into Excel and look at the value and the rewards of this investment strategy with an example. In this example, I'm going to compare two strategies. The first one is the DCA strategy, dollar cost averaging, and the second strategy is the lump sum investing strategy. So the first strategy, which is dollar cost averaging strategy, this person is investing $1,000 every month. For the lump sum, the person just invested $12,000 in the beginning of the year. Now, what you can see here is on that price, you can see how the price of the asset is fluctuating. So in month 1, the price is 50, in month 2, 48, by month 5 is 40, by month 8, 37. Now, what is happening for the DCA is that depending on the month, the number of shares that the person buys varies. But at the end of the year, the person has 284 shares. So by applying the DCA strategy, the person buys a varying amount of shares based on the price. Now, the first benefit that you can see here is you typically tend to accumulate more shares by applying the DCA strategy, more shares of the stock or the ETF or whatever else you're trading by applying this strategy. And this is because you are investing some amount of money, when the price goes down, you are able to buy more. When the price goes up, yes, you buy less. But the thing is, by investing some amount of money, you are able to automatically take advantage of price dips to buy more without, worrying about if you are buying too much or if this is the right time to buy. Because you know that, okay, if I invest 1K now, I will invest 1K the next month. Like, I'll keep investing some amount of money every month anyway. Versus the person who spent $12,000 in month 1, they bought 240 shares. This is because when they were buying it, the price of the stock was $50. So they bought 240 shares. But the DCA person at the end of the year has 284 shares. The person that bought 240 shares at the beginning of the year is going to have 240 shares at the end of the year. But the person that has the DCA strategy has more shares. So that's first benefit. Now, as we keep looking now at the portfolio value for both of them is going to change every month based on the price of the asset. But because there's a variation in the number of stocks that they both own, the number of assets that they both own, the number of shares that they both own, the DCA strategy is going to give you a higher return at the end in this example. So as you can see here, at the end of the year, the portfolio value applying the DCA strategy is about 14,000, whereas the portfolio value applying the lump sum investing is about 12,000. In fact, we can see here that the lump sum portfolio investor, we can even say that they're almost like they lost money, right? From like month 2, they begin to lose money. Between like month 5 and month 9, they are losing a lot of money compared to what they had invested. And by the end of the year, they are back where they started at $12,000. The DCA strategy does take time to ramp up. As you can see, it begins from $1,000 and it goes 2,000, 5,000, 7,000. So you have like a more steady growth rate in your portfolio versus the lump amount, which begins high, 12K, and it goes down, and then comes back up to $12,000. Like, both of them have experienced the same market situation, but the outcomes are radically different. Now, why does DCA work? DCA works for 3 main reasons. The first one is consistency. One important habit when you are building wealth is just staying consistent. I always say on this channel that wealth building is very simple. It just comes down to applying the same simple strategy consistently over time. Consistency is the name of the game, especially if you are trying to win with something like compound interest. And DCA allows you to be consistent in your investing. By setting up recurring investment every month, every week, every 2 months, you are staying consistent in the market. You are participating in the market every single time. But just investing $12,000, $20,000 in January and calling it a day, you will not be able to participate in everything that happens throughout the year. Being consistent in investing is the way you put your money to work for you. Many of us have automated payments for rent, for student loans, for electricity, for subscription. By using the DCA strategy, you are also able to automate, your investment, let's say every month or so. But instead of your money just going down the drain, like whatever money you pay for a student loan or for subscription, that money is used up. The money that you automate using the DCA strategy, builds wealth for you. The thing about DCA as well is that it eliminates downtime with your money. Because you are consistently investing your money, you are not waiting for the market being right. Many people will be waiting to time the market, so they'll be accumulating money in savings, just saving money and leaving the money there, and the money is doing nothing for them. Whereas if you are using the DCA, you can dip your toe in and just your money keeps growing for you no matter what is happening in the market. Second benefit is time-based investing. Just like I mentioned earlier, you can automate your DCA strategy. So every week, every month, every quarter, however you like to do it. But by investing early, instead of waiting and timing the market, you are maximizing the amount of return that you can get without compound interest. Like someone that invests in month 2 of the year versus someone that invests in month 5 or month 6 of the year. So that person has had 4 months where their money has been in the market out there working for them. So DCA allows you to just time your investment and maximize the amount of time that your money has, working for you. And the third benefit of DCA, which is one reason why I highly recommend it, is it helps you mitigate risk. And the 2 major risks that investors fall into is emotional investing. When it comes to investment and money, many of us think that we're rational, but most of the time, research has shown that we fall into a lot of emotional and mental biases when it comes to investing than we are humble enough to admit. By using DCA, you remove the anxiety and stress in trying to time the market, trying to figure out if this is the best time to buy, if this is the best time to sell. You just invest like a robot without thinking about it or without applying emotion. Second thing as well is that DCA enables you to let go of FOMO, fear of missing out. Many investors follow the pressure of following the market. The market is high, everybody's selling. I should go and sell. The market is low, everybody's buying. I should go and buy. And by doing that, We all know that in general in life, when you are following the masses, you are highly likely to make mistakes. But DCA prevents you from doing that. You only dance to the tune of your own drum, which is the automated investment that you have put together. So your money goes into the asset as you have predetermined it. You can tune out the noise. You can tune out what the majority of people are doing and save yourself from the FOMO that comes with just trying to, time the market and follow every investment news that comes out. Another thing about DCA that is great is that anybody can do it. It's as simple as just setting up a fixed amount of money every month that goes into your investment account and it's been invested for you. Now, I know anybody can do it, and I'm going to tell you how you can do it as well. But before I go into that, let me tell you mistakes to avoid when you are implementing DCA. The first one, and this is a very common mistake, is not assessing your budget before setting your fixed amount. Again, DCA works with you setting a fixed amount that goes into your account consistently. Now, for you to set that amount, you need to understand your budget. You need to be sure that the amount of money that you are putting into your DCA is the amount of money that you can afford every month. DCA works with consistency, the same amount of money every month in and month out. So what that means is, let's say this month you have $5,000 to invest, but next month you probably will have $2,000, and maybe next month you will have $4,000, and maybe next month you will have $1,000. It's within your interest to find what the average is. What's the average amount of money that I can put in? If that money is $500, if it is $1,000, it doesn't matter. What matters is that it is the same amount of money and you can bear to invest it over time. Because what happens is, if you put $5,000 now and you put $1,000 now, you are almost lump investing. You are falling into the same trap of the lump investing, and that is totally very different from DCA that we've discussed here. Another thing as well with this finding out your budget is that if you put too much money into your DCA, and let's say like next month you then need money, you will have to sell your investment, which will completely destroy or counter whatever benefits that you could have gotten by implementing this DCA strategy. So you want to lock your money in, you want to put your money there and forget about it. You want to determine an amount of money that you can put into your investment, applying the DCA strategy, and forget about not money that you will need next month or you will need in 3 months' time. And that's why before you even start, investing or doing any DCA, it's important for you to have emergency savings. When you have emergency savings, it frees up, your mind, and you can invest your money. You're not worried about meeting any emergencies that come. The second mistake people make with DCAs is starting too late. You want to start as soon as possible. Again, in investing or building wealth, time is always going to be very important, and it can work for you or against you. And the way that time works for you is by starting as soon as possible. Third mistake that most people make using DCA is following the market and stopping DCA when the market dips. Most people will be like, hey, something happens in the market, the prices has fallen, stock market has fallen 60%, I'm going to stop investing. That is the worst mistake that you can be making. Again, DCA is all about consistency. Same amount, same month, same time, every month or every day or every week. No matter what happens in the market. If the market dips, great, you invest. If the market goes up, great, you invest. If the market stays the same, great, you invest. You want to be like David Goggins, right? You run every single time, whether the rate is falling or not, you are in the market. Now let's talk about how should you do this. First, before you even start, sort out your emergency fund. But once you have an emergency fund and you're ready to do the DCA, you need to open a brokerage account. There are many platforms where you can do this, and I have a video coming up about brokerage accounts. Make sure you subscribe so you don't miss that. But many online apps allow you to do this: Betterment, Wealthfront, Robinhood, and so on and so forth. When you open a brokerage account, you want to set up recurring transfers from your checkings account. Determine the amount of money that you can use for the DCA strategy, $100, $500, $1,000, and set up automatic transfers from your checkings account for that amount of money into your brokerage account. And then set your brokerage account to buy a fixed amount of the index fund, ETF, or your stock based on how much money that you've transferred into that account. So this is very easy. You can set it up in 30 minutes, and I really encourage you to take action from this video starting today. Now, as I mentioned, your DCA only works if you are consistent with the amount of money that you are investing over time. And the only way you can figure this out is by knowing what your margin is. I have a video that I'm going to link up here about determining your margin. Your margin is the difference between your income and your expenses. And in that video, I'm going to talk to you about how to figure out the exact amount of money that you have as your margin, which is important for you to implement the DCA strategy. So go and watch that video and let me know what you think in the comment section below. Thank you for watching my video. I'll see you in the next one. Until then, stay rich and definitely build wealth. Bye.